We've looked at the balance sheet previously. Remember, this is another way to show that accounting equation. Okay, remember your accounting equation is A equals L plus E, or assets equals liabilities plus equity. And we looked at how we can take this information and put it into a statement, a financial statement, in the form of a balance sheet. And we showed you an account form, which looks just like the accounting equation. The assets are on the left and the liabilities and equities are on the right. They had to equal. Or we looked at it in report form, where it all flowed vertically. Assets were first and liabilities and equities, but those still had to equal. The assets had to equal the liabilities and the equities. So this looks similar to the report form. You may want to zoom in. This is still a little far out, but this shows you that report form of the balance sheet. Your assets are first, liabilities and equities are next. But if you notice on here, we don't just list all the assets like we did before. Now we have specific classifications. This is why we call it a classified balance sheet. It gives more detail to the balance sheet. So we're going to have some subcategories within each of our main categories to give us more details about what these assets are and what these liabilities are. So we're going to have categories of them. So let's go through what each of the categories you might see on a classified balance sheet. Start off with, let's go through categories of assets. And the first one you might see are current assets. And these are the order you would see these categories as well. A current asset is something that's going to be either converted into cash or used within 1 year or one operating cycle, which is usually a year or less. So usually you can stick with the 1 year parameter. So cash, for instance, and we already talked about how your assets are listed in order of liquidity, or the ability to convert them into cash, and that's how we list current assets. So cash is always your first thing, your number one, because it's already cash. But that's how we're going to list these current assets. Okay, so things that we use or will be converted to cash within a year's time. Next category we've got is investments. Now, sometimes you'll also see these listed as long-lived or long-term investments. Usually, if you have an investment, which can be a lot of things, usually you're talking about something like you've purchased stock in another company, for instance. That would be an investment. If you've purchased it with the intent to sell it next month, though, that wouldn't be in this category. That would be in the previous one. That would be a current asset because you're not expecting to hold it or have it after this year. So if you have things that are more short term, then that's still going to be a current asset. But if you have investments like your company had purchased some stock to have as a long-term investment, they don't intend to sell it anytime in the near future, that's going to be in this investment category. Let's say that they had purchased a piece of land and they're just holding it as an investment. They didn't buy it to build a building on for their factory, for instance. Then if they're holding it as an investment, that would be an investment, something like that. Okay, those things are going to be listed in a category called investments. Property, plant, and equipment. Sometimes you just see this referred to as PP&E. Other times you might hear it called fixed assets. Same thing, property, plant, and equipment, and the name kind of implies what's here. Property, plant, and equipment. So land, buildings, equipment, vehicles, all those types of things, long-lived assets are here. These are things that you use in your trade or business, and they have longer lives. So we have them in the property, plant, and equipment section. Now let me give you an example where some of this might get confusing. So just think through what the purpose of the asset is. What if you owned a vehicle? I mentioned vehicles before. If you owned a vehicle, you say, oh yeah, that's property, plant, and equipment. But what if you owned a vehicle and that was for a car dealership? They own lots of vehicles. Okay, have lots of vehicles on the lot. Are those assets of the company? Yes. Are they property, plant, and equipment? No. Those are actual items they wish to sell. That's called inventory. That's a current asset. Property, plant, and equipment would be the vehicle that they own that, let's say, they go and pick people up in, or they use as a actual company vehicle. That would be property, plant, and equipment, but not the cars they intend to sell. Okay, items they intend to sell is part of inventory. Or land. We mentioned land before. What if they owned land? Would that be part of property, plant, and equipment? Perhaps, but what if they had purchased the land with the intent to hold it as an investment or to sell it? Then that's not going to be in this category. But if they purchased land and they built an office building on it and that's their office that they operate out of, yeah, that's part of property, plant, and equipment. Okay, so just be careful. What's the intent of the asset? What's it being used for? Intangible assets. Oh, one more thing to mention about PP&E, property, plant, and equipment. There is a different kind of an account here. You'll see, say, land, equipment, vehicles, buildings, all those things listed. You'll also see an odd account called accumulated depreciation listed here. I don't want to get into too much right now. We're going to talk about that in a later chapter. But what happens is when you purchase, say, a piece of equipment, you buy it for $50,000. Well, over time, you're going to use that equipment, and it's going to decrease in value, but it's also going to decrease in usefulness. So we're going to take the cost of that, and eventually it will be an expense for us, not an asset, because we're using it and getting use out of it. Well, to do that, we call that depreciation. We show how much we've depreciated it. And accumulated depreciation just is the sum of all of the depreciation we've taken over the life of that asset. So we take that accumulated or added up into one account, and we subtract that from the cost of the asset. So you'd see, say, equipment for $50,000, and if we've depreciated $20,000 so far, you'll see accumulated depreciation of $20,000, and that'll give us something called a net or a book value of $30,000. Again, we're going to get much more in detail with that in the later chapter when we talk about property, plant, and equipment again and depreciation in much more specifics. But I want to go ahead and mention that now because you'll see that term accumulated depreciation already popping up on that classified balance sheet. So intangible assets. This is our last subcategory of assets. These are things, as the name implies, that are intangible. You can't touch them, see them, taste them, feel them, those types of things. So a couple of common examples for intangible assets would be goodwill, trademarks, copyrights. These are all things that have to do with business, your business. Coca-Cola, for instance. Have you ever seen merchandise by Coca-Cola and it has a little TM in a circle at the end of it, trademarked? Or you've seen copyrights before. See that copyrights deal more with, say, music or something that's a written piece of information, like a book, for instance. Those have copyrights on them. But these are all intangible assets. So they're still things that are an asset, but since they're specifically this intangible, we have a category for them all unto themselves. All right, let's switch over to liabilities now. Those are all our subcategories of assets. They have the most. Liabilities, we just have two. First one's a current liability. And again, current implies within 1 year. So these are things that we intend to pay within 1 year. So if you have something that you're supposed to pay it within at least a year, you stick it in current liabilities. If you're not going to pay it for more than a year, you put it in long-term liabilities. So if you had a note payment or a note and the term of that note is not due until 10 years down the road, that's a long-term liability. But let me give you a for instance where it might cross over. Let's say that you took out a loan with the bank and it's a 15-year loan, but you pay annual payments into them or even monthly payments. All of the payments that you'll make on that principal or that loan amount for the next year, within 1 year's time, you'll put that small portion into current liabilities. It's called the current portion of long-term debt. But all the rest of it, the stuff you're not going to pay for over, a year and later, that goes in long-term liabilities. Okay, so the difference between current and long-term, whatever you're going to pay within a year, current, anything after a year, long-term. And stockholders or owners' equity. And this one's the same that we saw on the previous balance sheet. It hasn't changed. You have those two accounts, capital or common stock, and then your retained earnings balance, just like we saw before. That one hasn't changed any. Exactly the same as before. So again, classified balance sheet, much more detail. Those different classifications are subcategories. In assets, we have current assets, investments, property, plant, and equipment, and intangible assets. Intangibles is not listed on this example, but that is another classification. And then for liabilities, we have current liabilities, long-term liabilities, and then we also have stockholders' equity, which that one hadn't changed. That one's the same. But again, you still have to balance this, even with all those subcategories. Total assets still need to equal the total of liabilities plus equities.